Welcome back, and thanks for joining us for today's quarterly observations in fixed income and global equities. My name is Adam Sparkman, and I'm a client portfolio manager here at Thornburg Investment Management. Today I'm joined by our co-heads of investment, Ben Kirby and Jeff Klingelhofer. Gentlemen, thanks so much for joining us today. Jeff, based on your balance sheet comments, where are we finding some of the best relative values in fixed income right now? And how do you feel about taking risk in the portfolios given the current environment?
Look, I think overall the starting place for fixed income investors is better today than it has been over the last decade and a half, right? Yields overall are higher. The benefit of that is there are some dislocations we're seeing, right? We talked about the US consumer being one of the spots that remains incredibly bright. Now we're watching it closely. But a lot of those opportunities on the front end of the curve, and with an inverted curve that actually allows you the opportunity to, one, get higher yield, and two, not have to extend nearly as much into that higher volatility if and when the recession does come to fruition, right? So we are focusing on US consumer, mostly securitized products on the front end of the curve. We see a lot of value there, more focused on the prime, very high quality consumers, very good structural protections. And we're also offsetting that on the longer end with some US agency mortgages, for instance, and treasuries, right? Things that we do think really will act as ballast if we get that recession either deeper or earlier than our expectations.
So Ben, maybe just broadening out a little bit, thinking back on the first half of the year, what's been the biggest surprise to you with markets? And then maybe looking forward to the second half of the year, what, if anything, keeps you up at night?
Sure, so I'll answer a couple ways. One is just the resilience of the US economy has been surprising. But a lot of that is not that the level of the US economy is so strong, it really is that expectations were very low going into the start of the year. So economic surprises on a broad brush have been positive for the US pretty much all year long. So stepping over a low bar is enough to make risk assets go up. The other big surprise, I think, has been home prices have gone up. So that was not something we expected early in the year. I think a lot of it has to do with 75% of borrowers have a mortgage at less than 4%, and they just don't want to move because that's an asset. And so that's creating a supply constraint, which is causing prices to reaccelerate even though mortgages are high and affordability is relatively poor.
How about for looking forward to the second half of the year? What keeps you up at night?
I think it continues to be geopolitical concern and risk. I mean, whether it's escalation in Russia, Ukraine, or it's something happening between the US, Taiwan, and China, there's just a lot of potential hotspots that could flare up.
Okay. Jeff, same questions for you.
Gosh, what surprised me, I mean, I'd have to agree with Ben, just the resilience of the economy. But overall, I think it's also the Fed reaction function in response to the resilience of that economy, right? Really, they're having to throw an entirely different playbook. And it's because the underlying fundamentals have become entirely different than what we've had in the past, right? With inflation now overshooting rather than undershooting consistently. And as I look forward to the future, I think it's the biggest challenge investors will face, and what keeps me up at night really as a fixed income investor is I think that playbook may have been fundamentally altered. Even as we do eventually have that recession, I worry the Fed won't be nearly as willing to cut rates to squash the downside. And I think that's not just true of the US. I think that's true of central banks around the world. That we're having to relearn what it is to live in an inflationary environment rather than a deflationary environment.